Toyota just flipped the auto industry on its head, and the shockwaves are ripping straight through the US auto market. What looked stable only months ago is now cracking in real time, and dealers, automakers, and buyers are all reacting. This is not a slow adjustment or a minor strategy shift. This is a hard pivot that has triggered panic, price chaos, and a complete reset of expectations across the American car market. Toyota made a move no one expected from the world's most disciplined automaker. Instead of protecting margins and slowing production like its rivals, Toyota leaned in aggressively. It ramped up supply, locked in pricing, and doubled down on models Americans actually want right now. While other manufacturers are cutting shifts, pausing factories, and quietly begging dealers to move inventory, Toyota is flooding the market with vehicles that undercut competitors on reliability, ownership cost, and long-term value. This single decision is detonating a chain reaction. US dealers who were holding firm on prices are suddenly watching customers walk across the street to Toyota showrooms. Financing desks are feeling the pressure as buyers compare total ownership costs instead of just monthly payments. Residual values are shifting. Lease math is breaking. Vehicles that were considered safe bets 6 months ago are now sitting longer on lots, losing leverage every week. Toyota keeps pushing. What makes this moment dangerous is timing. The US auto market is already fragile. Interest rates are still squeezing buyers. Loan delinquencies are climbing. Used car prices are slipping after years of artificial inflation. Inventory levels are rising faster than demand. Into that environment, Toyota just injected confidence, volume, and price discipline, a combination that exposes how unstable everyone else really is. Legacy automakers are trapped. If they match Toyota's pricing, they bleed margins they can't afford to lose. If they don't, they lose buyers they can't afford to give up. EV-heavy brands are especially vulnerable because Toyota is winning without betting the company on vehicles consumers are still hesitant to fully embrace. While others gamble on future adoption curves, Toyota is dominating the present. Dealers are already whispering about it. Incentives that were once temporary are becoming permanent. Floor plan costs are piling up. Marketing budgets are exploding just to maintain foot traffic. The confidence that carried the industry through post-pandemic shortages is gone, replaced by quiet anxiety and rapid recalculations behind closed doors. Consumers feel it too, even if they don't know why yet. Suddenly, Toyota looks like the smart, safe choice again. Not flashy, not experimental, just dependable, affordable, and available. That perception shift alone is enough to destabilize an entire market built on premium pricing and artificial scarcity. And this is where the meltdown accelerates, because once buyers reset their expectations, the market cannot go back. Once people believe better deals exist, they wait. Once they wait, inventories rise. Once inventories rise, discounts spread. And once discounts spread, the illusion of control collapses across the industry. Toyota didn't just launch cars, it launched pressure. Pressure on pricing, pressure on production strategies, pressure on every automaker that assumed Americans would endlessly absorb higher costs. The US auto market is now being forced to confront reality, and the companies least prepared for that reality are starting to crack first. What happens next will not be announced in press releases or earnings calls. It will show up quietly in dealer desperation, sudden incentive spikes, unexpected production cuts, and manufacturers scrambling to explain why demand didn't disappear. It simply moved. And as Toyota continues executing this strategy, the rest of the industry is being dragged into a fight it didn't plan for, at a moment it can least afford to lose, because the next phase of this shift is already unfolding as competitors realize that matching Toyota might save volume but destroy balance sheets, while refusing to match Toyota could erase market share faster than anyone is publicly willing to admit. And that impossible choice is now sitting at the center of the US auto market, growing more dangerous with every passing month. That impossible choice is forcing emergency meetings inside boardrooms across Detroit and beyond. Executives are staring at the same data and reaching the same conclusion. The old playbook no longer works. You cannot raise prices forever when one company is willing to sell scale, stability, and trust at a level customers recognize instantly. Toyota understands something critical that others ignored. In a fragile market, confidence is worth more than hype. As this pressure builds, cracks are already forming in segments that were once untouchable. untouchable. Mid-size sedans are moving again. Hybrid demand is surging faster than EV adoption ever did. Buyers who walked away from new cars during the price explosion are suddenly re-entering the market, but they are not shopping emotionally. They are shopping strategically, and Toyota is positioned exactly where that buyer mindset is landing. This shift is brutal for automakers who restructured their entire future around premium positioning. When Toyota offers lower long-term ownership costs, fewer reliability risks, and immediate availability, it quietly rewrites the value equation. That forces competitors into a defensive posture they were never designed to operate in. Plants built for high-margin models now face underutilization. Supplier contracts are being renegotiated under pressure. Marketing promises are being stretched thinner by the week. Meanwhile, used car values are starting to react. When new Toyotas become easier to buy at reasonable prices, the inflated used market loses its anchor. Trade-in expectations drop. Lease residual assumptions weaken. Finance departments feel the impact first, but it does not stop there. The entire ecosystem, from auction houses to lenders, starts adjusting downward in response. What makes this even more destabilizing is Toyota's patience. This is not a short-term promotion or a desperate volume grab. Toyota can afford to play the long game because it never abandoned fundamentals. Strong balance sheets, conservative forecasting, mature supply chains. That gives it endurance in a market where endurance is about to matter more than growth. Other automakers are now facing a credibility problem. They told investors demand was strong. They told dealers pricing was sustainable. They told consumers higher costs were permanent. Toyota's move quietly contradicts all of it, and once credibility slips, panic follows. Not loudly, but systematically. Dealers are adjusting their language. Salespeople are recalibrating scripts. Inventory managers are quietly pushing for faster turns, even at lower profit. These are not isolated reactions. They are signals of a market losing its pricing discipline one decision at a time. And the longer this continues, the harder it becomes to reverse. Because every sale Toyota makes at this level resets expectations for the next buyer, and the next, and the next. The pressure compounds. The floor drops incrementally, and automakers who delay responding are discovering that hesitation now carries a heavier cost than action. This is why the US auto market feels unstable, not because demand vanished, but because certainty did. Toyota introduced clarity into a system built on ambiguity, and that clarity is exposing weaknesses that were previously hidden by cheap credit and limited supply. As that exposure spreads, the industry is being forced to confront questions it postponed for years, about pricing power, about product mix, about whether consumers ever truly accepted the new normal or simply tolerated it under pressure. And right now, the answers to those questions are reshaping the market in real time, pushing competitors closer to a breaking point where every decision carries consequences that ripple outward, affecting not just quarterly results but long-term survival, especially as the next wave of buyers enters the market with sharper expectations, tighter budgets, and far less patience for anything that feels overpriced or unjustified. That new wave of buyers is not responding to marketing slogans or futuristic promises. They are responding to math, monthly payments, fuel costs, insurance, maintenance, resale value. Toyota is winning on every line item that actually matters. This is exactly why the shift is so dangerous for the rest of the industry. You cannot out-advertise a spreadsheet, and you cannot spin your way out of a value gap once consumers see it clearly. Inside competing dealerships, the tone has changed. The urgency is no longer about upselling features, it is about justifying prices. Sales managers are explaining why similar vehicles cost more with fewer guarantees. That conversation almost always ends the same way, with buyers walking away or asking for discounts that were unthinkable a year ago. Every one of those moments weakens pricing power a little more. Manufacturers that leaned heavily into EV-only strategies are feeling this squeeze the hardest. Toyota's hybrid-first approach suddenly looks less conservative and more calculated. Hybrids offer familiarity without fear, savings without sacrifice, and availability without infrastructure anxiety. As gas prices fluctuate and charging concerns persist, Toyota's lineup feels practical in a market that is losing patience with uncertainty. This is triggering a silent correction across product planning teams. Programs are being delayed. Future launches are being reevaluated. Some models will never reach production because the business case no longer survives Toyota's pressure. These decisions will will not make headlines, but they will shape what Americans can buy over the next decade. The financial markets are watching closely. Analysts are starting to question demand assumptions that once went unchallenged. Forecasts are being revised downward. The phrase pricing normalization is quietly replacing pricing power in earnings discussions. Those words may sound technical, but they signal something serious. The era of effortless profit is ending, and here is the part no one wants to say out loud. If Toyota maintains this pace, the industry will be forced into a broader reset, not a collapse, but a correction sharp enough to hurt. Plants will slow, employment decisions will follow, dealer networks will thin, the excess built during years of easy money will be exposed, and not everyone will survive the adjustment. Toyota does not need to dominate every segment to win this battle. It only needs to remain consistent while others stumble. Stability becomes a weapon when competitors are overextended. Reliability becomes leverage when trust is scarce. And right now, trust is becoming the most valuable currency in the US auto market. What we are watching is not chaos for chaos's sake. It is a system rebalancing under pressure. Toyota applied that pressure deliberately, knowing exactly where the market was weakest. As that pressure continues to build, every reaction from competitors adds another layer of volatility, another unintended consequence, another signal that the old rules no longer apply. And as buyers, dealers, lenders, and manufacturers all adjust at different speeds, the gaps between them grow wider, creating friction points that accelerate the shift even further, because once a market starts moving in one direction with this much momentum, stopping it becomes nearly impossible. And the next phase of this transformation is already beginning to surface in ways that most people have not fully connected yet, even though the warning signs are now everywhere, stacking on top of each other, pulling the entire industry toward a moment that will force decisions no one can delay any longer. Those warning signs are no longer subtle. Inventory reports are creeping higher, even as incentives quietly return. Dealers who swore they would never discount again are now testing price drops under different names, hoping to move metal without triggering panic. Toyota does not need to participate in that behavior because its vehicles are already priced in a way that feels justified, and that contrast is becoming impossible to ignore. Suppliers are feeling the pressure next. When volume shifts toward one manufacturer, the entire supply chain tilts with it. Capacity planning becomes unstable. Smaller suppliers face margin compression as automakers push for concessions to stay competitive. This strain eventually feeds back into production schedules, increasing the risk of disruptions and delays for brands already struggling to keep momentum. Financing is another pressure point. Lenders are tightening standards while Toyota-backed financing remains comparatively attractive. That creates a two-speed market where some buyers can move forward confidently, while others are stalled by higher rates and tougher terms. The result is uneven demand that favors the brands with the strongest financial arms, further widening the gap. The emotional side of the market is shifting too. For years, buying a car felt like losing a negotiation before it even started. Now, buyers sense leverage returning, but only in certain showrooms. That realization changes behavior fast. Consumers start cross-shopping again. They start waiting. They start questioning add-ons and markups. Once that mindset spreads, it is almost impossible to contain. Toyota's approach is exposing a hard truth. Much of the recent strength in the US auto market was conditional. It relied on scarcity, cheap credit, and limited alternatives. Remove even one of those pillars and the system wobbles. Toyota removed several at once, not by accident, but by design. Competitors are now chasing reactions instead of executing strategies. One month it is aggressive incentives. The next it is production cuts. Then comes mixed messaging to investors trying to explain why volume dipped, but margins must be protected. That inconsistency erodes confidence internally and externally at the same time. Employees feel it, dealers feel it, consumers feel it. Even if they cannot articulate why, they sense instability, and markets run on sentiment as much as numbers. Toyota's steadiness, contrasted against everyone else's recalibration, makes that instability more visible by the day. This is how a meltdown unfolds, not with a single crash, but with 1,000 adjustments that all point in the same direction. Each adjustment looks manageable on its own. Together, they signal a structural shift that cannot be reversed with one good good quarter or one successful launch. And as this structural shift accelerates, attention is turning towards segments that were assumed to be immune, including trucks, SUVs, and higher margin family vehicles, because once Toyota's pricing and availability logic starts influencing those categories as well, the ripple effects will multiply, forcing even the strongest brands to confront the same dilemma spreading across the market right now. And that dilemma is growing more intense with every passing decision that fails to restore the confidence the industry once took for granted. That dilemma becomes especially dangerous in trucks and SUVs because those segments have been carrying the financial weight of the entire industry. When pressure reaches those categories, there is nowhere left to hide. Toyota understands this, which is why its strategy is not loud or aggressive, but methodical. It is positioning itself as the rational alternative in a market saturated with overconfidence and overpricing. Competitors are now being forced to defend vehicles that cost tens of thousands more while offering little difference in real-world value. That defense grows weaker every month. Buyers who once stretched budgets for brand loyalty are pulling back. Fleet buyers are rerunning numbers. Small businesses are delaying purchases or shifting brands entirely. These are not emotional reactions. They are survival decisions. The internal strain at rival automakers is intensifying. Product teams argue with finance. Sales pushes back against production. Forecasts are revised, then revised again. Every revision chips away at long-term planning. When a company cannot confidently project demand 6 months out, it starts making short-term decisions that compound risk rather than reduce it. Toyota's restraint amplifies this effect. It does not chase headlines. It does not overpromise. It simply keeps delivering vehicles that meet expectations without forcing buyers into uncomfortable financial commitments. In a stressed market, that consistency becomes disruptive. The US auto market is now splitting into clear tiers. On one side are brands aligned with affordability, reliability, and realistic ownership costs. On the other are brands still clinging to a premium narrative that fewer consumers can justify. That gap is widening, and Toyota is pulling the market toward its side without needing to say a word. Policy uncertainty adds fuel to the fire. Emissions rules, EV incentives, and trade pressures all remain in flux. Automakers that bet heavily on regulatory stability are now exposed. Toyota's diversified approach reduces that exposure, giving it flexibility while others are locked into costly paths they cannot easily exit. As these forces collide, the pressure is no longer theoretical. It shows up in dealer meetings, supplier negotiations, and investor calls filled with carefully chosen language. Words like transition, optimization, and right-sizing are becoming common, signaling preparation for contraction rather than expansion. And while public narratives focus on innovation and future mobility, the real battle is happening quietly in pricing spreadsheets and inventory reports. Toyota is winning there, and those wins accumulate. Each quarter of stability strengthens its position, while competitors exhaust resources trying to defend structures that no longer fit the market reality. This is why the situation feels like a meltdown rather than a cycle. Cycles assume recovery on the other side. What is unfolding now is a reordering of priorities, where financial discipline and consumer trust outweigh spectacle and ambition. And as that reordering continues, more parts of the industry will be forced into difficult choices that cannot be delayed or disguised, especially as the economic backdrop remains unforgiving and buyer confidence stays fragile, setting the stage for even deeper shifts that are already forming just beneath the surface. Those deeper shifts begin to surface when even long-time loyal customers start questioning habits they never challenged before. Brand allegiance weakens when budgets tighten and alternatives feel safer. Toyota benefits directly from this hesitation because it does not require persuasion to look sensible. It simply needs to be present, available, and priced within reach. And that combination is proving more powerful than aggressive innovation narratives. Regional disparities are emerging as well. In areas where incomes are under greater pressure, Toyota inventory is turning faster while competitors accumulate excess stock. That uneven performance distorts national sales data, masking stress until it suddenly becomes visible in earnings misses and abrupt guidance changes. By the time those signals reach the public, the internal damage is already done. Dealership consolidation is quietly accelerating. Stores with high overhead and slow-moving inventory are being pushed to the edge. Some are merging, others are exiting entirely. Toyota-focused dealerships, by contrast, are stabilizing cash flow and retaining leverage with lenders. That imbalance reshapes retail networks in ways that will persist long after the current turbulence fades. The ripple effects extend into employment. Sales staff face commission pressure. Factory workers face shift reductions. Logistics providers face face unpredictable volumes. Each adjustment feeds back into consumer confidence, reinforcing the cautious behavior that favors dependable brands over aspirational ones. Toyota's advantage is not just operational, it is psychological. In uncertain times, consumers gravitate toward predictability. When headlines are filled with layoffs, debt concerns, and market volatility, a vehicle purchase becomes a risk calculation. Toyota lowers perceived risk, and in doing so, raises the perceived risk of everything else. Rival automakers are attempting counter strategies, but many of them conflict internally. Cutting prices undermines brand positioning. Holding prices undermines volume. Incentivizing dealers undermines transparency. Every option carries a downside, and Toyota's consistency magnifies those downsides by comparison. As the months pass, this imbalance starts influencing long-term capital decisions. Investments are delayed. Expansion plans are shelved. Research budgets are scrutinized more aggressively. The future becomes narrower and more cautious, especially for companies already stretched thin by ambitious transitions that have yet to pay off. What is happening now is not a sudden collapse, but a slow, grinding realignment. Toyota is not pushing the market off a cliff. It is removing the supports that allowed others to stand where they were. Without those supports, gravity takes over, and as gravity continues to pull the market toward affordability and realism, every stakeholder is being forced to adapt or absorb the consequences. Because the longer this environment persists, the more permanent these changes become, shaping buyer behavior, industry structure, and competitive dynamics in ways that will define the US auto market for years to come, especially as the next economic stress test looms closer and reveals just how prepared each automaker truly is. This is why what Toyota just did matters far beyond one company or one quarter. It exposed the fault lines running through the entire US auto market at the exact moment the industry could least afford it. Pricing illusions are fading, confidence is cracking, and the gap between what consumers can afford and what many automakers are selling is no longer easy to ignore. Toyota didn't cause the instability. It revealed it. By choosing discipline over desperation and value over volume at any cost, Toyota forced the market to confront reality. And now every automaker, dealer, lender, and buyer is adjusting in real time. Whether they are ready or not, the US auto market is not melting down because demand vanished. It is melting down because the rules changed, and not everyone can survive under the new ones. What happens next will define which brands remain pillars of the industry and which ones become cautionary tales. And as this reset continues to unfold, one thing is already clear. The era of unchecked pricing power is over. The era of consumer leverage is returning, and the companies that understand that shift early will control the future, while the rest are left reacting to a market that Toyota just flipped upside down.